Let's move on to non-current liabilities. All liabilities that are not classified as current are considered to be non-current or long-term. Long-term financial liabilities include bank loans, notes payable, bonds payable, and derivatives. Liabilities such as notes payable and bonds payable are usually reported at amortized cost on the balance sheet. At maturity, the amortized cost of the bond will be equal to the face value of the bond. For example, if a company issues $100,000 of bonds at a discounted price of 98.0, the bonds are reported initially as a liability of $98,000. Over the bond's life, the discount of $2,000 is amortized such that the bond will be recorded as a liability of $100,000 at maturity. Similarly, any bond premium would be amortized for bonds issued at a price in excess of face or par value. In some cases, financial liabilities are reported at fair value. Examples include held for trading liabilities, such as a short position in a stock, and derivative liabilities. Deferred tax liability is a tax that has been assessed for the current period but has not yet been paid. This deferral can be due to timing differences between the accrual of the tax and payment of the tax. For instance, a company earned an income for the year, and thus the tax expense for this income is recorded in the current period. However, the cash will not actually be paid until the next period and remains in the balance sheet. The solution for this accrual difference is to record a deferred tax liability to balance the books. Another way a deferred tax liability can arise is due to differences in the way net income is calculated for financial purposes and the way it's calculated for income tax purposes. For example, a company uses accelerated depreciation methods for tax purposes and straight-line depreciation methods for financial statement purposes. The taxable income in the earlier periods are lower than in the later periods. As less tax is being paid in the earlier periods, but the financial statements report a higher tax figure, a deferred tax liability has to be created to balance the books to account for the tax that is yet to be paid. As mentioned earlier, deferred taxes are not the easiest to understand, so don't worry if you can't fully comprehend at this point. We shall be discussing more on deferred taxes in a topic on its own later. And that's all for non-current liabilities. Up next, we shall move on to the last major component of a balance sheet, owner's equity. See you again.